Despite widespread uncertainties going into the year, 2017 turned out to be the most benign in financial markets since the global financial crisis, with nearly all asset classes producing positive returns and most measures of volatility at all-time lows. The MSCI World Index and the S&P 500 both produced positive returns in each month, and by year-end had returned 22% and 21% respectively. Emerging markets fared even better, with the MSCI Global Emerging Markets Index, led by Asia, up 37%. Bond markets were more subdued but still produced positive single-digit returns, with credit and emerging markets leading the way. What factors drove those gains? Can they continue through 2018, and what risks lie ahead for investors? Economic fundamentals were the key underpin to markets. The first synchronized, sustainable global expansion since the crisis broadened and deepened as the year progressed. The US continued its steady progress. The previous laggard, continental Europe, surprised on the upside. China managed to achieve its targeted growth, and developing countries in general benefited from the pickup in global trade and their earlier structural reforms. At the same time, inflation surprised on the downside, so enabling central banks to maintain extraordinarily loose monetary conditions despite the accelerating growth that we saw. Even the Fed, the central bank which is furthest through the monetary cycle and has made progress towards normalization of policy, still has an extremely accommodative policy by any historical measure. Despite the disruptive threat across many industries from the rapid pace of technological change, the favourable global conditions helped the corporate sector to a strong year for corporate earnings. Finally, the worst fears of populism, EU disintegration, protectionism, trade wars, conflict in North Korea, escalation of conflict across the Middle East, they all failed to materialise. While it seems inconceivable that the benign conditions of 2017 can continue through 2018, there's no doubt that the global economy enters the year in the best shape since the financial crisis. Growth has been accelerating. The capital investment cycle, which has been weak throughout the post-crisis period, is now turning upwards, so underpinning the expansion. Confidence and other leading indicators are almost universally pointing upwards, and inflation remains very low. The expansion phase of the economic cycle is still at a relatively early stage and has further to run, particularly bearing in mind the depth to which the global economy sank in the crisis period and the subdued growth that we've seen since then. So the corporate sector is likely to enjoy another year of strong profits, helping to support valuations in equity markets. I think investors can be encouraged too that caution and worry have remained the dominant sentiments so far in this cycle, and there are few signs of excess, bitcoins and Hong Kong real estate accepted. However, the inflection point in the global economy in 2017, moving out of this sluggish and uncertain years since the crisis, will be mirrored in 2018 by an equally important turn in the monetary cycle. For the first time since the crisis, all central banks will be progressively moving away from the ultra-loose policy in place for almost a decade, and by the fourth quarter of this year, on a net aggregate basis, they'll be withdrawing liquidity from markets. At the same time, those central banks which are furthest down the track of policy normalization, most importantly of course the Fed, will continue to raise interest rates. This critical policy change removes from the market the biggest buyers of safe haven bonds. By the end of September this year, the Fed will be cutting its bond holdings significantly. The ECB will have stopped new investments, as has the Bank of England already. And the Bank of Japan will be tapering its purchases. While neither the European Central Bank nor the Bank of Japan will raise interest rates this year, with the current trajectory of the economy in the US, the Fed will raise rates as it projects, up by 75 basis points by the year end. Now, policy normalisation moves have been well flagged to date, and the removal of support will remain gradual, but the transition ahead is likely to be the biggest hurdle for markets this year. Bond yields have risen significantly since the lows in mid-2016, and particularly so in recent months at the shorter end of maturities in the US. The yield on 2-year Treasury bonds has risen by 70 basis points in the past 4 months to its highest level since 2008. There's been a significant flattening of the yield curve, and investors are watching for an inverted curve where yields on short-dated bonds exceed those on longer maturities, as this often gives an early signal of recession ahead. Central banks have been able to maintain this extremely loose policy at a time of accelerating growth, largely because inflation has remained tame. Although there's been a modest tick up in recent months, underlying inflationary pressures remain low. Critically, despite falling levels of unemployment across the developed world, and in the case of the US and UK to near record lows, wage inflation has remained weak. As growth continues to move ahead and unemployment falls further, it's likely that wage pressures will increase, and this will be a key indicator to monitor for potentially disruptive implications. However, capital spending is now picking up, and a return to meaningful levels of productivity growth, so weak since the crisis, would keep the inflationary impact of rising wages in check. At this stage, while we're clearly in a reflationary stage of the cycle, a return to the traditional boom-bust remains distant. In part, it's because of the considerable structural headwinds that exist: aging populations, falling working age populations, and high debt levels globally, which are a long-term constraint on growth. These, we think, will prolong rather than curtail the cycle, which appears to be sustainable for quite some time ahead. The risks to this broadly positive backdrop are, first of all, policy mistakes by central banks as they navigate through this key turning point in the cycle. Tighten too quickly and the economic recovery will be cut short, leave it too late and inflation takes hold. Then there are policy mistakes potentially by governments, most importantly, I guess, in the chaotic Trump administration. Tax cuts and reflation policies are being implemented in the US when the economy is growing strongly and close to full employment, while protectionism and trade wars are a clear threat. Then there's China's ability to continue to manage its long-term structural slowdown and debt mountain while sustaining growth at politically acceptable levels. With the 19th National Congress of the Communist Party of China out of the way, will President Xi, emboldened by his all-powerful position, embark on increasingly tough measures to curb credit and reduce pollution, both likely to slow growth? Fourth, acceleration of inflation is clearly a risk, especially wage inflation. This would force central banks to tighten policy more aggressively, and I think arguably that's the biggest single risk to markets this year. Geopolitics, an ever-present risk, but despite obvious areas concern not a material influence on markets in the past year, can this persist with the indeterminate consequences of Trump's resetting of the US's international relationships, as well as the quagmire that is the Middle East spilling over into vital countries such as Iran and Saudi Arabia? That would spell danger for the oil price, already back to a 3-year high and 150% above the 2016 lows, as global demand for oil is combined with OPEC discipline in cutting production to bring the market back into balance. Then finally, there's a sort of resurgent dollar as a risk. The dollar has surprised by weakening significantly in 2017, down 10% on a trade-weighted basis, with growth accelerating in the US as tax cuts take effect, and the interest rate differentials between the US and other major economies set to widen materially as the year progresses. Could the dollar surge ahead, triggering a slowdown and potential dislocation, especially in developing markets? Notwithstanding these risks and uncertainties, the world enters 2018 in good health. The backdrop for risk assets is favourable. However, 2018 will be a more challenging year than 2017's Goldilocks environment. Expectations are much higher at the start of this year, and growth is unlikely to surprise on the upside, inflation on the downside, to anything approaching that in 2017. This year's key turning point in the monetary cycle, with a withdrawal of central bank liquidity and a gradual tightening of financial conditions, presents an increasing headwind. The big risks have now moved from deflation and slow growth towards reflation and accelerating growth. At the same time, valuations, already high as we entered 2017, have been pushed higher by the strong performance of markets. From these levels, return expectations must be realistic and highly unlikely to match those of the post-crisis period to date. It's too early, in our view, to be calling an end to the cycle. The pickup in growth comes after a long period of subpar activity. The recovery is well grounded, sustainable, and given the sizable output gaps across much of the global economy, it's unlikely to trigger a surge in inflation that would in turn cause a sudden, unexpected tightening of policy. Neither recession nor an unsustainable boom seem in prospect. Furthermore, an uptick in inflation at this stage of the cycle will be welcome to central banks, corporates and investors after the extended period of dangerously low levels verging on deflation, especially across Europe. With no signs of overheating ahead, the equity risk premium could even fall, helping to offset the valuation drag of higher interest rates. Driven by strong corporate profits rather than any further revaluation, we expect equity markets to make further progress this year, albeit with lower returns and somewhat higher volatility than in 2017. Within markets, we expect the favourable growth environment to be supportive of those countries and sectors which are the most economically sensitive. Emerging markets, Japan, cyclical and value stocks which lagged significantly in 2017, and financials which are finally leaving behind their post-crisis problems and are set to benefit from improved margins as interest rates move up. The bigger challenge for investors in constructing multi-asset risk profile portfolios lies in traditional safe haven assets, bonds. Strong growth, tightening financial conditions and rising interest rates are a potentially toxic mix for government bonds, and the rise in yields in recent months is set to continue through 2018. Other sectors of the bond markets are unlikely to be immune from this move, particularly as the search for yield has driven most markets to extreme valuations. Fixed income positioning should therefore focus selectively on short duration bonds and credit. Credit risk in general remains more attractive than interest rate risk. With increasingly favourable fundamentals for the developing world, emerging market debt appears the most attractive part of fixed income markets. However, the peak in interest rates in this cycle is likely to be well below that in previous upswings. And as the year progresses, there could well be opportunities in some safe haven markets, most notably US Treasuries, if yields rise as seems likely. It remains the case that alternative assets, including infrastructure, selective property markets, gold, and liquid alternatives, which typically exploit market inefficiencies while hedging away market risk, hold attractions as portfolio diversifiers with low correlations to other assets and the potential to provide more defensive exposure as markets hit the inevitable bumps as the cycle progresses. In currencies, the extended weakness of the dollar was one of the biggest surprises of 2017. The dollar should be well supported this year by rising interest rate differentials against all the other major currencies, and the euro in particular is unlikely to enjoy the big upside surprises of 2017. So less extreme movements therefore seem likely this year, alongside some modest recovery in the dollar. But as always, it remains important to keep broadly diversified across currencies and avoid short-term position taking in what is undoubtedly the most unpredictable of markets. In summary, although we don't expect a repeat of the strong returns of 2017, we believe that equity markets will make further progress this year. Although valuations in many cases are stretched, the underlying fundamentals are as good as they have been for many years, and the monetary policy tightening ahead is unlikely to be disruptive, but more a welcome confirmation of some return to normality. Not yet the old normal, but no longer perhaps the new normal. There are risks ahead, and from these levels longer-term returns are likely to be relatively modest. However, this cycle is particularly long, and we don't see evidence of overheating and a premature downturn. Opportunities for returns outweigh the risks, and it'll be important to stay invested. The inevitable return of periodic bouts of weakness in equity markets will present buying opportunities. With careful diversification, making use of the increasing range of asset classes which exhibit relatively low correlation with traditional assets, 2018 promises to deliver at least mid-single digit returns, albeit with bumps on the way.